This is the Scrap Metal Commodities Recycling Report by BENLEE and Raleigh Goldsboro Recycling, April 24th, 2017. This is a special remote edition due to our attending the annual Recycling ISRI meeting in New Orleans. Last week, commodity prices and economic reports were mixed. U.S. steel production rose for a second week, remaining nicely ahead of last year. But to keep things in perspective, the left chart shows China produced about 72 million metric tons in March, a historic high. The right chart shows at least they did not flood global markets with their excess. Their internal consumption is up, so exports are down. Here's the sad part. In 2016, the U.S. produced 79 million metric tons for the year. China produced almost as much steel last month as we produced last year. Oil fell $3, ending at $49 a barrel. OPEC and aligned OPEC countries have been cutting production as the U.S. ramps up, therefore keeping a lid on global prices. The oil rig count rose to 688, near a two-year high. Over $40 to $45 a barrel has brought drilling back. The oil rig count is now more than double the 316 low of a year ago, but still down a major 57% from 2.5 years ago. Iron ore fell to about $67 a metric ton. While still about double last year's $37, prices have been falling for weeks. Scrap ferrous prices held steady as volumes into scrapyards remains down a bit. As we look to next month's prices, many say we are close to equilibrium, so prices could be slightly up or slightly down. Hot dip galvanized steel fell to $900 a metric ton on softening automotive production and pressure from lower priced imports. Stainless 304 scrap continues steady at 37 cents a pound. Unless there is a major change soon, though, this will decline in the coming weeks following nickel down. Copper fell 2 cents to $2.55 near a multi-month low and is slightly up this morning. The 5-year chart shows the recent downward trend, but we are near about 30% higher than we were a year ago. The 1-year inventory chart shows inventories are up over 80% from a year ago, which puts downward pressure on these prices. Aluminum rose a penny to 87 cents, remaining near its recent high. And the 5-year chart shows prices remain near these highs based on strong markets. Aluminum inventories continue to fall. A few years ago, inventories were more than 3 times what they are today. Word of recent China aluminum production shutdowns are part of this decline. The market U.S. manufacturing PMI Purchasing Manager Index fell to 52.8 in April from 53.3, the lowest reading since September 2016, indicating a further slowdown in manufacturing growth from the near 2-year high in January, mainly due to slower expansion in output and new orders. U.S. housing starts fell a bit to 1.2 million units annualized, but that is 2.5 times what it was in April 2009. Great news in that home construction is a major driver of good jobs and helps stabilize commodity prices. U.S. sales of previously owned homes jumped 4.4% in March to an annual rate of 5.7, the highest since February 2007, more than 10 years ago. Importantly, the average price was up 3.8%. The Eurozone, which is most of Europe, had the Purchasing Manager Index rise to 56.7, the highest since April 2011. This measure of growth is important to global activity due to the Eurozone has a larger economy than the U.S. or China. Growth supports stable to higher prices. U.S. initial jobless claims remain incredibly low despite rising a bit to 244,000. Related, workers that have been laid off for more than a week fell to 1.98 million, the lowest level since April 2000, 17 years ago. As always, feel free to call me or email me with any questions, and we hope all have a safe and profitable week.